Welcome to Financial Fitness JA. I'm Julio Dawkins.
And I'm Jade Harrison.
Sit down, Philip.
Yo, I worked though. Let's go again. No itchy, let's go again.
Hey guys, welcome to Financial Fitness JA. I'm Julio Dawkins.
And I'm Jade Harrison.
And today we're going to give you some basic definitions of investing. In our previous videos, we have spoken about investing more in detail. In this video, we're just giving you clear definitions of the terms and terminology that are used in investing. Jade, I know there's a lot of terms being thrown around and people don't understand. We want to start with our first term, buy.
All right, we can just quickly go through our list of things that we'd like you guys to note and how we have the definition. Buy is when you take a position in a stock. You know, just like when you buy anything else. You buy a house, you buy some stock, you're taking a position in a house, a financial position. We have sell. A sell is when you get out of a position or you take a position that is going to benefit from the downside. So you're not necessarily getting out of, it's taking a bet on the downside. So, which is really a short, a variation of a sell. I don't know if I'm being very clear on that. That's more of a short than a sell, but they're crossover definitions. Bid. A bid on a stock quoting platform is the price that the buyer is willing to pay for shares or a stock. So basically what you're willing to pay for a stock on the platform, that's what they're offering. So this is the bid rate where you should be willing to pay. It changes consistently and you decide when you're willing to pay at that rate. I don't know if I'm being clear enough, but I'm going to try and be as clear as possible, guys. Ask price is where the price the buyer is willing to seek when selling the shares. So, but that's what they're asking of you to buy the shares from them. That's my understanding of it. So that's your ask. Okay. Bid ask spread is the difference between the two. So it's the difference between your buy price and your sell price. Bull market, I don't know if you want to go on this one, I don't know if you're familiar.
Yeah man, definitely. Bull market is when you expect the market to rise. In the Jamaican context, Jade, you can bet against the market only when it's rising, but not when it's falling, right? Can you short a market in Jamaica versus short a market in the US? I think that's a big difference.
You can short any market, but a bull market by definition is a market that is going up. Right? Bear market is the opposite.
Which
a market
is
that's going down. So it's like if you have an index for the market and the index is going down, that's a bear market. If it's going up, that's a bull market. Some persons like to trade on a bear market and some persons like to trade on a bull, depending on their strategy. You have funds that are short funds that focus on shorting stocks or selling stocks that benefit mostly in a bear market. Just general bear market. And then there are value investors and people like that to bull market.
So a limit order now. What is a limit order?
It's basically a type of instructions that the order is basically to do a transaction at under a specific limit. I don't know if that's the best way. At a specific sale price or buy price.
So you're saying if I buy something for $3 and it reaches $4, that's my limit order. If it reaches $4, I want to buy back. I want to sell back that stock or buy back that stock.
You're looking at the stock. It's at $3.
Right.
You want to buy it at $2.50. You're going to put a limit order at $2.50. So whenever it hits $2.50, you buy it at
just when you buy it. Oh, okay.
A market order. A market order is where you buy at the market value, which is wherever it's at right now.
Wherever it is.
Or wherever it may be when the market opens, because you can set an order before the market opens.
Right.
People don't encourage market orders as frequently as they do limit orders because they should know where the trade is profitable, but sometimes they just want to get into a transaction, or if you're at an organization, you might need to just take a position. Then people might go about market orders like that.
A good till cancelled order.
It's self-explanatory. The order remains open until you cancel it. So it can be left open forever. So you can, if you have a good till cancel and you don't cancel it and it hits 10 months online because you forgot about it and you lose money, that's on you. Good till cancel. And you have some good till close, which is like at the end of the day, if the trade is not hit, the transaction is cancelled.
Cancelled. Oh.
Right?
So it's like, but that's more like a time limit thing.
They call it like a day order. It's similar to a day order. So that's only good until the end of the day. Basically, that's what it's saying.
Okay,
It's not executed, it's cancelled automatically.
Okay. When people say that the market is volatile or volatility, what they're trying to say to you?
This is the intensity in the highs and the lows. I know how often they are taking place. It's actually an index that they use on Bloomberg terminals. VIX, called the Volatility Index, is a measure of how the market is moving up and down sporadically. And it's like a general volatility index. So it's like the risk that is inherent in the market, the erratic nature of the market, unless you graphed and tracked. Liquidity, as a definition term, in the sense that stocks, is how quick or how slow you're able to get in or get out of the stock, meaning buy or sell the stock. So what you might find is that some stocks, like for example penny stocks, not all of them are as liquid as a major traded stock. Or for example, you can use it in the sense of currencies. The most vehicular currency is the euro. It's the euro. Which is traded the most frequently, the euro.
Wow.
Right, but the US is the base. So by definition, it is just as significant. But the reality is that if you were going to trade Jamaican dollars on the international market, it is definitely not as liquid as the US or the euro. So that you can use this as a comparative basis to say, all right, I get what you're saying.
So yeah, that guys, the euro is actually the most traded currency. I did not know that. Well, I know that the US is the base. So good one, Jade. So trading volume. So at the end of the day, when I sit down and I hear the news, well, the market traded this amount of volumes and whatever. What do they mean by that? What are they trying to say
Just the amount of transactions relative to the stock market in general. Some days there are a lot of people doing transactions, and some days are very low volume days. Like for example, let me give an extreme example to bring it clear and to the point. On holidays, there's very little trading volume relative to a busy day where some kind of economic data is coming out or indicator is being published or things like that. So trading volume varies based around the news, the date, time of year, economic data. Volume fluctuates with that.
Okay. So going long.
Going long, we can refer back to where I was talking about short, where I kind of jumped the gun in terms of when you're short in some shares, what you actually do is you borrow the shares from somebody. By definition, this is all the structure. You don't have to do all this, but this is actually what you're doing. You're borrowing the shares from a broker. You're selling those shares with the hopes that the shares price will actually go down and you can buy it back cheaper. And then you are going to return the shares you borrowed, but you would have made that spread. That's a short. A long is when you buy the stock, just like anything else, like a house or so. You buy it for $10,000 and you say next 10 years it will be worth $10 or $100,000 and you will make $90,000. That's taking a long position with the expectation that's going to go up.
Is I don't know if you can correct me. Is the shorting that you call something almost like using a leverage?
It is not necessarily leverage. Leverage is a different concept. Leverage is like a loan. So what a bank or institution, not a bank, a financial house will do, they will say if you have $10 or just like a credit union, you can borrow 10 times what you have.
In your shares, right?
That's exactly what leverage is. So you can buy up to 10 times the amount of capital you have put out there. But that exposes you to greater risk because you're now exposed to 10 times what you're able to afford. So 10 times the reward, but 10 times the risk. So leverage is something that a lot of rookies play around with and lose. That's why I say a lot of people go into FX trading mainly and they blow up their accounts because the account can't handle the volatility. And that's a key mistake most people make, thinking leverage is. Leverage is good if you understand what you're doing and you're managing your risk professionally, like at a professional standard. Not necessarily professional, because the knowledge is there, but a professional approach.
Well, and you have to keep very aware of it. So averaging down, I've heard this term a lot, and I don't necessarily understand what you're trying to say.
I explained. If you guys refer back to our Tesla video, where I spoke about buying the Tesla share, the first one at $900, then it fell to 300 and something, and then I ended up buying some at 400. So in essence, what you're gonna do if you want to, basically I've averaged down my cost by saying You're going to take those two prices, add them together, and now I have, instead of having one share at 910, I have two. One at 910 and one at 400. When you add those two together, say, let's just say for cleanness sake, it comes to 12. So $1,200 for two stocks. So how much one stock costs overall? $600 as opposed to one cost in 9 and all my costs was 9. Or buying both at 9.
That is averaging now?
That is averaging.
Whoa, that's amazing.
It's actually a simple concept that is very powerful.
It's simple.
So if you, but it works on the premise that you believe in what you're buying. So if you think that Tesla is going to be, or any other stock is going to be a good long run play, most people would get scared if the stock goes down and run. But if you're a solid, seasoned investor, you'd say this is an opportunity to buy more and average down my cost, and that's what you do.
And averaging down it can lead to other things, even to forex, even to it's a concept that can use.
Yeah, but forex is different than stocks, though.
Well,
the volatility and the market is different.
Definitely.
So I don't know. As in, like, it's not something you necessarily want to keep long-term a currency unless you're like a bank. Only banks take longer-term positions like that. And some traders do, but not many.
Even in business, I can tell you that if I'm going to purchase an item from a distributor at $10 and then I can get it again at $6, I still need to work out my average cost. So
it's exactly
so
that.
It's pretty much can be transposed to different industries.
But when them say averaging down your cost is like an active version of that. But that's exactly what it is.
Capitalization.
This is how much value is in the market. So the value of the company as a whole. So like your market cap is the amount the company is valued as a whole. And then the entire market capitalization is the accumulation of all the companies on that listed exchange. So that will give you the general market cap. And then you can, based on that, you can determine what size company, and you can now do a relative comparison across industries, sectors, and things like that. So you use your market cap to determine, do I want a small cap where there's more opportunity to grow, or do I want like an Apple, the largest company in the world, by market cap, which is not going to have a super significant amount of growth.
Yeah. You have drop gems and bombs. Trust me, we do this.
Yeah.
Guys, this is an excellent way to start out to understand what these terms and definitions mean. And click the link below to our investment video where Jade also has continued talking about the Tesla stock. And Jade, we do this.
We do this
all the time.